There is only one currency on Earth that cannot be printed by a central bank. It is not gold, and it is not Bitcoin. It is the very force that allows gold to be mined and Bitcoin to be validated. It is energy. If you strip away the stock market, the credit scores, and the currencies, the global economy only runs on one thing. Energy is the absolute limit of our civilization. It is the hard ceiling that no amount of monetary policy can break through. Most investors spend their entire lives distracted by the scoreboard. They look at the gross domestic product numbers. They look at the nominal price of the Standard & Poor's 500. They obsess over interest rates and the balance sheet of the Federal Reserve. But these are just shadows on the wall. They are financial claims. They are paper promises. We have tricked ourselves into believing that money itself is wealth. We look at a bank account balance and we feel safe. We look at a stock portfolio hitting an all-time high and we feel successful. But money has no intrinsic value. You cannot eat a dollar bill. You cannot heat your home with a credit card statement. Money is only valuable because it is a claim on the real resources that sustain life. The laws of economics are flexible. We can change the tax code. We can change the interest rate. We can change the definition of a recession if we really want to. We can print trillions of units of currency and inject them into the banking system overnight. But the laws of physics are not flexible. You cannot negotiate with the laws of thermodynamics. You cannot print a barrel of oil. You cannot print a megawatt of electricity. You cannot quantitative ease your way out of a physics problem. In this video, we are going to explore a concept that very few investors ever truly grasp. We are going to look at the thermodynamics of wealth. We are going to deconstruct the economy, not as a social science, but as a physical system. When you make this shift, everything changes. You realize that the inflation we are seeing is not just a policy error. It is a thermodynamic signal. You realize that the volatility in the bond market is a symptom of a much deeper imbalance. We are living through a unique moment in history where the world has confused financial assets with real assets. We have built a global financial system based on the assumption of infinite, cheap energy growth. But the physical reality underneath that system is changing. We are moving from an era of energy abundance to an era of energy constraints. And when the supply of energy tightens, the value of the money in your pocket must mathematically decline. By the end of this presentation, you will stop seeing money as currency, and you will start seeing it as a battery. You will understand why the smartest money in history is quietly moving away from paper assets and into the physical resources that power the world. This is the mindset shift that protects wealth when fiat currencies falter. Welcome to Mindset for Wealth. Here, we step back from the daily noise of the news cycle to analyze the hidden, long-term forces shaping the global economy. Our mission is to help you build a fortress of stability in an unstable world. If you appreciate analysis that respects your intelligence and focuses on the decades ahead, please take a moment to subscribe to the channel. Let us begin by looking at the first principles of money.
Welcome to Mindset for Wealth, where money meets mindset.
To understand the true nature of wealth, we must go back to the most fundamental rule of the universe, the first law of thermodynamics. This law states that energy cannot be created or destroyed. It can only be transferred or changed from one form to another. This sounds like a concept for a physics classroom, but it is actually the most important lesson in economics you will ever learn. Every single good or service in the global economy represents energy that has been transformed. The food on your table is solar energy transformed through photosynthesis. The steel in your car is heat energy transformed into structure. The data on your smartphone is electrical energy transformed into information. Nothing happens without an energy input. Now, let us contrast this physical reality with our financial reality. In the world of finance, we operate under the illusion that we can create value out of thin air. A central bank can press a button and create $1 trillion of liquidity in a matter of seconds. They can expand the money supply without limit. But here is the critical disconnect. While they can print the currency, they cannot print the energy required to give that currency purchasing power. The Federal Reserve can print $1 billion, but they cannot print 1 billion barrels of oil. They cannot print the millions of years of geological pressure required to create natural gas. They cannot print the copper required to transmit electricity. When you understand this, you realize that money is not wealth. Money is merely a claim on wealth. More specifically, money is a claim on future energy. When you hold a $100 bill in your wallet, you are holding a certificate that gives you the right to demand a certain amount of energy from society. You can trade that paper for a tank of gasoline, or for the energy someone else expended to cook you a meal. The paper itself is worthless. The energy it commands is everything. For most of human history, our money was tied directly to this physical reality. Gold and silver were used as money for thousands of years, not just because they were shiny, but because they were a proof of work. To get an ounce of gold, you had to expend a massive amount of energy to find it, mine it, and refine it. The scarcity of the money was guaranteed by the scarcity of the energy required to produce it. You could not simply inflate the supply of gold because you could not cheat the laws of physics required to get it out of the ground. Money was a store of past energy expenditure. However, the modern financial system has broken this link. Since 1971, when the United States severed the link between the dollar and gold, we have been operating on a pure fiat standard. We detached the symbol from the reality. We allowed the supply of money, the claims on energy, to grow exponentially, while the supply of actual energy grew only linearly. We created a system where the financial economy could expand infinitely, unmoored from the physical constraints of the real world. This creates a dangerous illusion. When the government prints money and sends out stimulus checks, people feel richer. The numbers in their bank accounts go up. But because no new energy was created to match that new money, the ratio of money to energy changes. There are now more claims chasing the same amount of real resources. The result is what we call inflation. Most economists will tell you that inflation is complex, driven by supply chains and expectations. But the thermodynamic explanation is simple. Inflation is the market's way of repricing the currency to match the physical reality. It is the laws of physics reasserting themselves over the laws of economics. We are currently living through a time where the discrepancy between financial claims and energy reality is at its widest point in history. The total value of global stocks, bonds, and real estate has ballooned to hundreds of trillions of dollars. All of these assets are essentially bets that there will be enough affordable energy in the future to justify these valuations. But what happens if the energy is not there? What happens if the cost to extract that energy rises? The paper claims must be discounted. This is the silent correction that is eroding the middle class. It is not that things are becoming more expensive. It is that your money is becoming a weaker claim on the energy required to produce those things. To understand why the global economy feels so fragile right now, despite record highs in the stock market, we need to look at a single metric. It is not the price-to-earnings ratio, and it is not the consumer price index. The most important number in the world is what scientists call EROI, energy return on energy invested. This is a concept that applies to every living system in the universe, not just the economy. Think of a cheetah hunting on the African savanna. The cheetah must expend energy to sprint and catch a gazelle. If the cheetah burns more calories chasing the gazelle than it gains from eating the gazelle, it will starve and die. It does not matter how fast the cheetah is. If the energy cost of the hunt is higher than the energy reward, the system collapses. The cheetah needs a positive return on energy invested just to survive. But to thrive, to reproduce, to feed its cubs, to play, it needs a massive surplus of energy. Human civilization operates on the exact same principle. For us to build skyscrapers, run the internet, fund pension systems, and support a complex financial sector, we need a massive surplus of energy. We need to get far more energy out of the ground than we spend getting it. During the 20th century, we experienced the greatest economic boom in human history. We often attribute this to capitalism, or technology, or democracy. But the thermodynamic truth is that we simply found the highest quality energy source ever discovered. In the 1930s, when we drilled for oil in places like Texas or Saudi Arabia, it was incredibly easy. You could practically stick a shovel in the ground and oil would gush out. The energy return was astronomical. For every 1 barrel of oil, purely invested in drilling, we extracted 100 barrels of oil in return. This ratio of 100 to 1 was the magic formula for modern wealth. It meant that we only had to spend 1% of our energy budget on getting energy. The other 99% was free surplus. We used that massive surplus to build the interstate highway system, to fight world wars, to create the middle class, and to fund modern medicine. Because energy was so cheap and efficient to access, everything else became cheap. Growth was easy because the energy wind was at our backs. But that era is over. The easy oil is gone. We have picked the low-hanging fruit. Today, we are forced to look for energy in difficult, expensive, and hostile environments. We are drilling miles deep under the ocean floor. We are fracking shale rock in North Dakota, injecting millions of gallons of water and chemicals just to squeeze out a declining flow of oil. We are processing tar sands, which requires massive amounts of heat just to separate the oil from the dirt. The physics of this new reality are brutal. Instead of getting 100 barrels back for every one we invest, we are now seeing ratios closer to 15 to 1, or in some cases, even lower. We are running harder just to stay in the same place. The energy cost of energy has skyrocketed. This means a much larger portion of our economy must be dedicated solely to keeping the lights on. The surplus that we used to use for art, for culture, for profit margins, and for social safety nets is shrinking. This is the hidden driver of the stagnation we feel. When you hear politicians talk about stimulating growth, they are trying to print money to compensate for the fact that our physical energy return is declining. But you cannot print energy efficiency. As EROI falls, the cost of doing everything in society rises. We are moving from a high-efficiency civilization to a lower-efficiency civilization. This acts like a permanent, invisible tax on every dollar you earn. The cheetah is having to run faster and faster for a smaller and smaller meal. And the financial markets, which are priced for perpetual exponential growth, have not yet priced in this thermodynamic reality. Many investors, when confronted with the reality of energy depletion, point immediately to technology. The counter-argument is seductive. We are moving into a digital economy. We have artificial intelligence, the cloud, and the metaverse. We are becoming more efficient. Surely, technology allows us to grow without needing more oil or gas? This is the illusion of the dematerialized economy. It is the belief that we can decouple economic growth from the physical world. However, this belief relies on a fundamental misunderstanding of what technology actually is. Technology does not eliminate the need for energy. Technology is simply a mechanism to consume energy in new and more complex ways. The internet is not a cloud floating in the sky. It is a sprawling network of massive data centers, subsea cables, and cooling systems, all of which are voracious consumers of electricity. Consider the rise of artificial intelligence. To the average user, ChatGPT is just a helpful chatbot. But from a thermodynamic perspective, it is an energy beast. A standard Google search requires a tiny amount of electricity. An AI query, because it requires complex computing power to generate an answer, can consume 10 to 30 times more energy than that simple search. As we integrate AI into every smartphone, every car, and every business process, we are not saving energy. We are creating a massive new source of demand. We are adding a new layer of energy consumption on top of what we already use. This brings us to a concept known as the Jevons paradox. In the 19th century, an economist named William Stanley Jevons observed that as steam engines became more efficient with coal consumption did not go down. It went up. Why? Because as energy became more efficient and useful, we found more ways to use it. The same is true today. As we make our devices more efficient, we do not simply pocket the savings. We build more devices. We build bigger screens. We process more data. The history of human civilization shows that efficiency never leads to less consumption. It always leads to more. Furthermore, we must look at the so-called green transition. There is a narrative that moving to wind and solar will free us from the constraints of resources. But wind and solar are not free energy. They are technologies that harvest energy, and they must be built out of physical matter. A wind turbine is a massive structure of steel, concrete, and fiberglass. An electric vehicle requires 4 times the amount of copper as a gasoline car, plus lithium, nickel, and cobalt for the battery. This transition does not mean we stop needing the earth. It means we need to dig up the earth even faster. We are shifting from a fuel-intensive system to a material-intensive system. To build the green infrastructure that governments are promising, we would need to mine more copper in the next 30 years than we have mined in the entire history of humanity up to this point. And how do we mine that copper? We use massive diesel-powered excavators. We use explosives. We use energy. Therefore, the idea that the economy is dematerializing is a myth. The digital world is built on a physical foundation. The cloud stands on the ground. If the cost of the energy required to mine the copper and power the servers goes up, the cost of the digital economy goes up with it. You cannot have a high-tech future with a low-energy reality. The two are inextricably linked. Investors who bet solely on tech stocks while ignoring the energy and materials required to build that tech are betting on the penthouse while ignoring the foundation. So, what happens when the irresistible force of money printing meets the immovable object of energy scarcity? We arrive at the inevitable correction. This correction will not necessarily look like a typical stock market crash where prices fall 50% overnight. Instead, it will likely manifest as a melt up in the cost of living. This is a scenario where the stock market might stay flat or even rise in nominal terms, but the purchasing power of your gains collapses. When financial claims exceed the available energy, the market must resolve the imbalance. It does this by making energy-intensive goods much more expensive relative to everything else. We are already seeing the early stages of this. The price of essentials food, heating, transportation, and housing materials is rising faster than the price of discretionary luxury goods. This is because essentials are energy-dense. You cannot digitize a loaf of bread. You cannot digitize the heat in your radiator. These things require real-world atoms, and atoms are becoming expensive. The trap that most investors fall into is that they are positioned for the old world. They hold portfolios filled with consumer discretionary stocks, technology companies with high valuations based on future growth, and long-term government bonds. These are all assets that perform well in a low-inflation, low-energy cost environment. They are essentially short energy. If energy prices double, the profit margins of a consumer company collapse because their input costs soar and their customers have less money to spend. By holding these assets, you are betting against the laws of physics. You are betting that energy will somehow become cheap and abundant again, despite the geological evidence to the contrary. Strategic positioning in this environment requires a complete mindset shift. You must stop chasing growth and start chasing input costs. You need to align your wealth with the physical reality of the planet. This means owning the producers, not just the consumers. It means having exposure to the companies that own the oil reserves, the natural gas fields, the uranium mines, the copper deposits, and the agricultural land. These companies are often viewed as boring or old economy by Wall Street. They do not trade at 100 times earnings. They do not have flashy product launches. But they possess something that the tech giants do not. They own the base layer of the economy. When inflation rises, it is usually because the commodities they sell are rising in price. Their revenue is indexed to inflation. By owning them, you are effectively hedging yourself against the destruction of your currency. You are taxing the inflation that is taxing you. This is not a call to become a speculator or to day trade oil futures. It is a call to structure a fortress balance sheet that can withstand a decade of resource scarcity. It is about recognizing that in a world of depleting resources, the person who owns the resource wins, and the person who holds the paper claim loses. Ultimately, wealth is not a number on a screen. Wealth is the capacity to command resources to improve your life. The financial world is a hall of mirrors designed to distract you from this truth. It wants you to focus on the symbol, not the reality. But the laws of physics always win against the laws of economics eventually. As we move deeper into this century, the gap between paper promises and physical limits will close. The investors who understand the thermodynamics of wealth will be the ones who preserve their purchasing power. Those who ignore it will be left holding paper while the real world becomes unaffordable. Thank you for watching Mindset for Wealth. If this analysis gave you a new perspective on your financial future, please subscribe and turn on notifications. We will continue to break down these complex macro trends in future videos. In the meantime, I recommend you watch our previous deep dive into the energy war nobody sees to understand the geopolitical side of this story. Stay informed, stay calm, and always look at the bigger picture.